macroeconomic data, market performance, to express to our clients what's going on in the economy right now in a global perspective, but also where we see the economy and markets going over the next 6 to 12 months. So what I'm going to do today, take you behind the curtain, show you how the sausage is made. I want to have some fun with it because this is macroeconomic data. I love it, my team loves it, but I don't need you falling asleep on me, all right? So with that said, yes, a little bit of volatility today, all right? And to be honest, a lot of it has to do with Moody's downgrade of U.S. debt. And essentially, our thoughts are, you get no credit for being last to the party. All right, S&P actually downgraded U.S. debt back in 2011. Fitch did so back in 2023, if you all remember that. And a lot of it had to do with political discourse and the potential for higher deficit. And so today we actually had a treasury auction that was a little bit soft. So when yields went up, it's caused a little bit of volatility in markets. That kind of happens. You can have a bad day, week, month, even year in markets. They tend to be higher over time. But with that said, I want to jump into talking about where all of this volatility is sparking from. So to start the year, the expectation for markets was to continue on to build onto the strength that we saw over the last 2 years. In fact, we had 2 consecutive years of over 2% GDP growth. To put that in context, trend growth for the U.S., the real GDP is roughly around 1.7 to 1.8%. And so we had 2 back-to-back strong years of performance, of market performance and growth. And so this year, many people expected post-election that these pro-growth policies from the administration of deregulation, potentially easier capital restraints on banks, and essentially an extension of the Tax Cuts and Jobs Act would continue to be a tailwind for that growth going on this year. It's almost like a three-peat, essentially. The Bulls of the 90s going for that 3rd championship. But instead, we kind of got the Kansas City Chiefs version of a three-peat. The difference is that we hope that this year isn't over in the first quarter like that Super Bowl was. But what was driving that volatility has been trade policy uncertainty. And so this chart right here is showing you essentially the U.S. effective tariff rate going back to the early 1900s. Now, one thing that was sort of left out when I was talking about those pro-growth policies was trade policy. And so tariffs were part of sort of on the campaign trail, but many economists and strategists really expected that the tariffs on China were really what the administration would focus on. There were a couple of rumblings of Canada and Mexico, but it was essentially, many economists and strategists expected around 50 to 60% tariffs on China over the next 2 years, and not really adding a lot to drag on growth or an upside on inflation. And so what we saw this year, though, was essentially announcements that kind of caused people to be concerned about overall U.S. growth. Now, what this chart on the right side is showing you how the U.S. effective tariff rate essentially has moved since we've gotten a lot of those announcements. So Liberation Day, which was April 2nd, really pushed higher the effective potential tariff rate to the highest we've seen since 1930. Now, many economists and strategists expected anywhere from a 10 to 20% effective tariff rate, and instead we got 25 to 27%. So far exceeding expectations. In fact, if you actually Google at one point, I think Goldman Sachs had a 45% chance of a recession, then 60% chance after Liberation Day, and then when we got the 90-day pause, they completely pulled recession off the table. So it's thrown a lot of people into sort of a head spin of trying to figure out what's going on here. Is the administration trying to secure the border? Are they trying to negotiate better trade deals? Or essentially, are they trying to unwind globalization? And so a lot of that uncertainty is really what's been driving some of those, that spinning, that volatility that you've seen in markets overall. And at the same time, it's showed up with small business uncertainty at a high level and optimism sort of coming back down. Where we see the effective tariff rate actually landing is probably anywhere from 13 to 15%. So having a drag on GDP, but not as high as what we saw from Liberation Day. And what that takes into consideration is many of the substitutions, the exclusions, as well as the negotiations and trade deals that we've been hearing about over the last few months. Now, tariffs can impact the economy in a couple different ways. For business owners like yourselves, essentially it increases your overall costs and compress your margins, hurting your free cash flow, your ability to use that money in order to expand operations or overall function with your overall businesses. Now, for the consumer, it can be essentially demand destruction, right? If you're the consumer going out to buy goods, essentially it's diminishing your purchasing power. And may, in some instances, you may forego on certain purchases because now the overall price has increased by maybe 10% or 20%, depending on what the good is. From an export standpoint, what you can see from countries and what we've seen from some of these bilateral agreements was we've seen essentially retaliatory tariffs. It could also lead exporters to essentially, or importers of U.S. goods, from avoiding importing from the U.S. overall. And so it does have a dragging effect on overall GDP. So typically pulls down GDP and has a short-term impact on overall inflation. Now from a small business perspective, the chart on the left is showing you sort of how uncertainty has risen to fairly high levels, some of the highest levels we've seen since 2015. And in fact, post the election, we saw small business optimism spike, which was positive because many people were taking into consideration those pro-growth policies I talked about. But tariff announcements have really sort of saw optimism fall, and with it, uncertainty has climbed overall. And that's because FedEx survey shows on the right here, around 88% of small businesses have some sort of impact on tariffs. Either 42% a lot, depend on them on imports, or 46% somewhat. So tariffs actually filtering through to small businesses, which are a significant size of the overall economy, either from a labor standpoint or overall GDP, which is almost around 50%. Now, before I talked about its impact on growth, our expectation pre-Liberation Day was we would see around 2% GDP growth. Our estimation brings it around 0.5 to 1% for the U.S. Inflation pushing up a little bit higher. So as the Fed has been trying to navigate bringing inflation down to that 2% target, tariffs are kind of pushing it up in the short term, up to around 3% our expectation by the end of the year. Now that's the core side of inflation. With the other side, the good side of inflation can be a little bit more volatile, as we've seen with energy prices fluctuating recently on announcements. Now, on the right side of the chart, we're kind of showing you essentially what a 10 percentage point move on the increase of the U.S. effective tariff rate can do to inflation and GDP. It typically has a 1% drag on growth and pushes inflation up by a similar magnitude. So ultimately, tariffs can be a bit of a headwind for growth overall. However, there is one positive thing. I know I've said all these dire things and you're wondering, are we headed to a recession? What's going on here? I expected more positive news. We don't see a recession coming, we just expect weaker growth this year overall. And part of the reason that it's not a recession is because we see the consumer on very solid footing. Now, part of that reason is inflation, although we do expect a short-term bump because of tariffs, that it is still ticking downward overall. And that the consumer has been able to digest these higher prices because wage growth has been at 3.8%. So they're seeing real wage gains above inflation. But as this chart on the left is showing you, household debt as a percent of disposable income is quite low. If you think about it, how many people in this house, in this room, have a mortgage rate below 5% or 5% or lower? There you go. There you have it. The majority of your balance sheets and your mortgage and your rent hasn't been impacted by the fact that interest rates were elevated. So being that you're not as sensitive to those changes in interest rates as you would be in another environment or in Europe where it's much shorter than the 15 and 30-year mortgage rate, we've seen many households be able to endure these higher prices and higher interest rates. We have seen an uptick in sort of credit card delinquency rates, which you see on the chart on the right, but we do see asymmetry in the path forward for the Fed. That, albeit before we had a lot of trade policy uncertainty, we expected them to cut rates. But if growth is weaker, they'll end up cutting a little bit more, and in a recession, they cut a lot more. However, the only thing that's keeping them at bay is they're trying to see the signal through the noise. Much of this uncertainty is causing them to be in much of a wait-and-see mode. But the path forward is lower interest rates, so that's a positive sign for business owners looking to either finance or looking to purchase a building or things of that nature. So something to think about. Now, when it comes to Tampa, I kind of wanted to look at specific data in the region. And what was interesting is the Port of Tampa, the largest in Florida and one of the largest in the country, actually saw a significant uptick in overall total imports in March. Now, part of that reason was many importers trying to get ahead of that April 2nd tariff announcement, which was also interesting because it was also the highest level we've seen the U.S. trade deficit in history. So that moved up in March as well. Now, there's a positive sign to that. If importers are bringing in inventory ahead of this announcement, that means those new prices haven't yet impacted those goods. So it gives us a little bit of time to wait to see how the White House is going to negotiate. So hopefully imports as they come in will hopefully won't be impacted as much as they would have been if April 2nd actually had played out the way it was priced in the markets. So seeing this pull forward in imports is a positive sign. It gives a little bit more wiggle room over the next few months while the White House figures out a way to negotiate better trade deals. Now, being we're in Tampa, I want to talk about the real estate market overall. We've seen a bit of a boom over the last few years. And one part I wanted to point out were building material costs meaningfully risen and tariffs can add a little bit more to it. And so the chart on the left is showing you sort of pre-pandemic, 2016 to 2020, and then since then, 2020 to 2024, and how different materials, lumber, concrete, steel, and that's in the dark blue is showing you before the pandemic, and the teal is after. So you see those prices rise significantly, obviously, after the pandemic. But on the right side, you can see how home builders import exposure to those same goods. So some of these materials are actually impacted by tariffs as well. So that's another reason why we're hoping for better trade deals and a lower effective tariff rate will have an impact on the housing market to a certain extent. Now, when it comes to housing, we've seen a bit of a cooling in the Tampa Bay market. I know some of you have seen those prices still pushing up quite a bit. The left side of the chart is showing you how the median home price is actually risen. So I use the baseline of the U.S. and threw in San Francisco because we all know how prices in San Francisco are way too expensive. We've actually seen the prices in Tampa Bay actually exceeding that overall. On the right side, the affordability has actually come down. So Tampa's in that dark blue line. The U.S. is in teal on both sides of the chart. And San Francisco, staying unaffordable, is in that bottom orange line. The green line is sort of the affordability. We've seen affordability dip down in this area. Now, sort of shifting from a seller's market to more of a buyer's market, we've seen the days of listing a lot higher relative to the rest of the U.S. and San Francisco. So houses are staying on the market a little bit longer, and overall, people are not paying above asking price. So the chart on the right shows the percent of homes selling above asking is roughly around 10% in Tampa relative to the rest of the U.S. So I figured I'd go and sprinkle a little information out there for you on the real estate market. Once again, the positive news is, hopefully as the Fed can start to ease rates, this will provide a little bit of relief there. It will likely push prices back up because people will be more apt to jump back in the market, but it should provide a little bit of relief in the real estate market overall. Now, last thing I wanted to touch on was AI. I know there's a lot of uncertainty out there, but we recently released our mid-year outlook, which is comfortably uncomfortable. 5 questions that investors should think about, everything from Trump 2.0 to building resilient portfolios. But one thing that we actually put in there was, why isn't anybody talking about AI anymore, right? Was it just a buzzword, or is there more to it? And so it actually makes me think about a story that I've often told to sort of explain or express the importance of AI. Anybody remember the Pinewood Derby? Or anybody have kids that competed in the Pinewood Derby? Awesome. Okay, I see you hand back there. So I grew up as the oldest of 6, mostly boys. My mom, bless her soul, even the dog was a boy. We were competitive as hell. And we competed on everything. And so the Pinewood Derby, part of Cub Scouts, is a competition for those who don't know. You take this little piece of wood, and all the cars have to be the same weight. You get to whittle it down, make it aerodynamic. And I had a plan. Me and my stepdad worked on this car all night, and essentially I was going to be there, you know, kick butt, take names, whole 9. Did not go that well. I was actually get my butt kicked. It was terrible. In fact, I'm crying. He's trying to figure out what's going on. Come to find out, the car was underweight, and so essentially we added a little bit more weight to it, and I start winning. Now, I didn't get first place, but I ended up in 3rd place overall. The reason why I tell this story is because for companies trying to compete, regardless of the sector, who aren't considering AI in their business model, are going to be just like my car, underweight, trying to keep up with businesses that are able to do so at a lower cost and able to generate higher sales. In fact, McKinsey estimates that in some sectors you can see cost reductions of up to 40%, and an improvement in sales of up to 20%. And if we go back to earlier this year, with DeepSeek Monday, for those who remember back in March, we actually saw China created a large language model at a fraction of the cost of some of the hyperscalers. So if you look at the chart on the left here, you're seeing the cost per million of token, and how essentially these large language models have essentially gotten cheaper, but also generating a more efficient and effective output. And so that teal line is actually showing you a PhD human, where they would be in the field, how they would compete these exact same questions. So this is essentially Google's graduate level approved Q&A test. And it's showing exactly where an individual would score on that test, and where these models started, where their cost was, and how the cost has come down, and they're scoring even more efficiently over time. And so what we saw from DeepSeek Monday is it's lowering the barriers of entry. So all of you that maybe with businesses that are considering investing in it, it was way too expensive. And it's still maybe too expensive for some of you, but we're seeing the cost coming down. So we think it lowers the barriers of entry and the ability for business owners to jump in and lean into that market. Ultimately, we haven't seen adoption rates moving up quite enough, but we believe that they'll continue to grow over time. In fact, all industries are around 6.5%. And so I think a lot of times when people think AI, they think, oh, it's just tech companies, it's just communication services, but we actually see the breadth of it across various industries overall. And we think it's something that every company should consider in their business model in some sense, because you don't want to be like my Pinewood Derby car that's underweight, and the rest of your competition is able to do so at full strength here overall. And honestly, the last thing I want to put to is that McKinsey estimates that by 2030, about $13 trillion of GDP will AI contribute to overall. So if you think about that, that's half of US GDP in general. So with that said, I've hit you with the fire hose version of our mid-year outlook. I've given you a lot to